global stocks and bonds, business free market opportunities are few. The old debt king gross has found a new target 1-year treasury bonds. 财新 July the 12th, editor 肖像 Global stock, bond and currency markets continued to fluctuate sharply on Monday amid apprehensive trading sentiment. The dollar index rose sharply. U.S. bond yields dropped back, and U.S. stocks fell significantly. Traders still seem to be digesting the risk of further aggressive interest rate hikes by the Federal Reserve and recession in Europe. The ICE dollar index, which tracks the dollar against 6 major currencies, rose 1.2% for the day, continuing to hit a 20-year high. The index has a large weighting in the euro, and the sharp drop in the euro-dollar exchange rate overnight further highlighted the strength of the dollar. The world's most traded currency pair once dipped to 1.0033, just a step away from the first time in nearly 20 years to touch the red line of euro parity. In recent weeks, market sentiment has been swinging between a recognition that central banks need to aggressively raise interest rates to combat soaring inflation, and concerns that excessive monetary tightening could lead to a global economic slowdown. Both arguments are now firming up investors' bullish sentiment toward the dollar, especially because the risk of recession in Europe is seen as higher. In the bond market, 10-year U.S. bond yields ended last week's 4-day rally on Monday to fall back in line with the trend in European bond yields, as market concerns about the prospect of a recession reheat. Among them, the 10-year U.S. bond yield fell 8.6 basis points on the day, at 2.999%, back below the 3% mark. Other maturities also fell across the board, with the 2-year yield down 3.3 basis points at 3.084%. The 5-year yield down 6.7 basis points at 3.063%, and the 30-year yield down 7.3 basis points at 3.178%. 2-year and 10-year yields continue to maintain the yield inversion that signaled a recession. This looks more like a traditional safe haven pattern, said Zachary Griffiths, interest rate strategist at Wells Fargo. There's been a massive sell-off in U.S. equities and a massive sell-off in European and Asian markets. This latest bond market rally is interesting given the large supply of U.S. Treasuries in the coming days. U.S. stocks began the week lower across the board, as investors awaited new inflation data and corporate earnings reports that could influence the Fed's path of interest rate hikes. All 3 major stock indexes opened lower overnight, then recovered some of their lost ground before losing momentum again at the close. Among them, the S&P 500 fell 44.95 points, or 1.2%, to 3,854.43. The blue chip Dow Jones fell 164.31 points, or 0.52%, to close at 31,173.84. The Nasdaq Composite Index fell 262.71 points, or 2.3%, to 11,372.60 as technology stocks weakened. Many industry insiders said that as the year progresses into the middle of the year, all major market categories seem to be in a moment of uncertainty right now. The first half of the stock and bond double kill scene is still hard to say has come to an end. While many commodity prices have been from the first 4 months of this year's super bull market out of crude oil, agricultural products and industrial metals prices have fallen more than 20% from the year's highs. This summer is likely to usher in a summer of turmoil. The old debt king grows new target. It is worth mentioning that, in the face of the current market full of risk and uncertainty, the old debt king Bill Gross also seems to have a deep sense, despite the Wall Street adage that there's always a bull market somewhere. Gross wrote in his latest investment outlook, "I'm having a hard time finding it." for investors who want to buy long-term bonds, stocks, and commodities at their lows. Gross advice today is all don't do it. Gross uses a number of indicators, such as Bollinger Bands and the standard deviation of the historical level of the federal funds rate to predict the Fed's actions, concluding that the Fed will safely create a mild recession, which in turn will gradually reduce inflation. Against this backdrop, all three asset classes are likely to underperform on the long side, given that the 10-year U.S. bond yield is currently around 3%, compared to 1.5% at the end of last year, which means that bonds are less risky, but also barely the stock market has to deal with disappointing future performance, and is not as cheap as it seems. So it is also not worth buying. As for commodities, they are now almost out of gas. In this regard, Gross believes that the 1-year Treasury bonds are a better choice than the above investments, because the current Fed rate hikes led to the possibility of economic recession a lot. The 12-month Treasury yield is 2.7%, which is better than money market funds and almost all other investments. Gross, 78, said. Right now, investors need to remain patient. Gross also cited his 2013 research at the Pacific Investment Management Company, PIMCO. Said the world is currently in the economist Minsky proposed framework of speculative financing stage. That is, more credit flows into financial speculation, rather than supporting economic growth. The result is that the Federal Reserve cannot raise interest rates too early and too high. Otherwise, the leveraged U.S. economy and the rest of the world will sink with it. Gross, co-founder of U.S. bond giant Pacific Investment Management, PIMCO, has been urging investors to take a cautious stance since the beginning of the year. And the facts bear out Gross' foresight, as stocks and fixed income assets suffer historic declines.